Welcome to the Gold Trading Podcast, where we delve into the intricacies of the gold market. Welcome to the Gold Trading Podcast, where we delve into the intricacies of the gold market.
Okay, let's unpack this gold. For millennia, it's been way more than just some shiny metal, hasn't it? It's this primal symbol, captivating humanity, this idea of wealth, permanence. But for traders, people in the financial markets, gold isn't static at all. It's like this living, breathing asset. It's got its own language, constantly reacting. Today, we're diving deep into that world, specifically XAUSD trading. And if you're wondering, what is XAUSD? It's just the price of 1 troy ounce of gold, but measured against a US dollar. Simple as that. Our mission here. Cut through the noise, the complexity around gold trading. We want to give you the essential insights, understand the mechanics, the risks, and the opportunities too. We've looked at expert analysis, trading guides, trying to get the clearest picture.
Yeah, and what's really fascinating about XAUSD, it isn't just another currency pair, not at all. It's more like a barometer for the global economy. It reflects investor psychology, reacts to critical data points. Honestly, understanding its moves gives you this unique lens, into much broader market forces, helps you figure out the bigger stories playing out in finance well beyond just gold.
Absolutely. And that's what we're aiming for, giving you those crucial nuggets of understanding without hopefully burying you in jargon. So whether you're kind of new to how markets work or maybe you're seasoned and want to sharpen your focus on gold, this deep dive is for you. Let's shed some light on things. So let's kick off with the big one. Why is gold such a huge deal? Especially in finance, we always hear safe haven asset is like the go-to phrase in a crisis. But what does that really mean? What are the characteristics that give it that status?
Right, that safe haven tag. It's not just fluff, it's fundamental. Gold, being a precious metal, it just has this magnetic pull for investors when things get turbulent. Think about times of high inflation, recession fears, geopolitical spikes. But here's the really deep part, the key difference. Unlike stocks where you're betting on a company or bonds relying on a government's promise, gold has zero counterparty risk.
Zero counterparty risk. That sounds important.
It's huge. It just is. In the absolute worst case, when other assets might default or collapse, gold stands alone. It's sovereign, a universally accepted store of value. And that fundamentally changes how pros think about it in a crisis portfolio.
Wow. Okay. The no counterparty risk point really lands, especially thinking about systemic risk.
Right.
What else defines its value beyond just, being shiny?
Oh, definitely more. Its core characteristics are pretty solid. First, scarcity. There's only so much gold on Earth. Finite supply. You can't just print more like fiat currency. That puts a psychological floor under its value,
Right. Can't just hit 2 crore plus P on gold.
Yeah, exactly. Then there's its intrinsic value. It's not just jewelry. It's crucial in high-tech electronics. And critically, central banks hold tons of it. Massive reserves. And that's not just tradition. It signals its role as a foundational fallback asset for entire nations.
And it always seems to come up when we talk inflation. How does that work?
Yeah, it's often seen as an inflation hedge. Historically, when fiat money, dollars, euros, whatever, loses purchasing power, gold tends to rise in value. It helps preserve wealth. Think of it like an inverse relationship over time.
Okay.
And finally, gold acts as a really sensitive market sentiment indicator. If the price of gold is climbing, it often signals fear or unease bubbling up in stock and bond markets. It's like a global financial weather vane telling you what the smart money might be worried about.
Okay, so gold's clearly deeply woven into finance. But for you listening, it's not just about buying a gold bar anymore, is it? There's this whole complex world of ways to actually trade or invest in it.
Oh, absolutely. The market offers a whole spectrum. You've got the spot market that's basically XAUSD, the immediate price. Then futures contracts, traded on exchanges like COMEX. You agree on a price for delivery later. For easier access, there are ETFs, exchange-traded funds. They track gold prices, but trade like stocks. Super popular.
Right. I see those mentioned a lot.
Yeah. And then for more dynamic, leveraged approaches, you have derivatives. Things like options and CFDs, contracts for difference. That's basically betting on the price difference without owning the underlying gold.
So lots of different paths in. What does that variety mean for different people, connecting it to the bigger picture?
It means gold is incredibly versatile. Whether you're a big institution looking for long-term stability against systemic risk or, a retail trader looking for short-term speculative plays on volatility, gold's unique properties can be leveraged in different ways. It speaks to its enduring, adaptable role.
Okay, so we know what it is, why it's valued. Let's peel back the next layer. What actually makes the XAUSD price move, day to day, minute to minute. It's definitely not just jewelry demand, right?
No, not at all. It's a complex dance. Powerful macroeconomic forces, microeconomic factors too. Pro traders aren't just guessing, they're constantly watching this interplay. It's an evolving ecosystem.
Let's start with maybe the biggest one, the US dollar. How key is that relationship?
Critical. Absolutely critical. Because gold is priced globally in dollars. So there's almost always this inverse correlation, like a financial seesaw, as you said.
Right, the seesaw.
Yeah. When the USD gets stronger, gold becomes more expensive for buyers using other currencies. That can reduce demand, push prices down.
And the flip side? Weak dollar.
Weak dollar tends to make gold cheaper, more attractive, so prices often rise. It's fundamental.
Okay, got it. What about interest rates? Gold doesn't pay interest, so how does that fit in?
That's a really crucial point. Gold is non-yielding. No dividends, no interest payments. So when interest rates go up, the opportunity cost of holding gold increases.
Meaning you could be earning interest somewhere else, like bonds.
Exactly. You could be earning a return on a bond, even a savings account. That makes holding non-yielding gold less attractive, so prices often fall.
And when rates fall.
The opposite happens. Gold becomes relatively more appealing compared to lower-yielding assets. Prices tend to rise.
And then there's inflation, always lurking.
Always. Gold's historical reputation as an inflation hedge means when the CPI, the Consumer Price Index, shows big increases, demand for gold often picks up. People are trying to protect their purchasing power. But this brings up a really important question. How do these things interact?
Yeah. Because it's never just one thing, is it?
Rarely. For instance, rising CPI might suggest gold should go up. But if the US dollar is also surging really strongly at the same time, that strong dollar could actually push gold down in the short term, even with high inflation. It's complex. Sometimes contradictory forces are at play.
Exactly. The market's never a simple A plus BC equation. Beyond those big $3 rates, inflation, what else moves the needle for gold?
Oh, definitely geopolitical risk. That's a massive one. Things like wars, political instability, major global crises. They often send investors flocking straight to gold. It's that safe haven instinct kicking in, causing sharp, sometimes immediate price jumps.
Yeah, you see it all the time. Any major global event hits the news, and gold reacts almost instantly, like a knee-jerk global anxiety meter.
That's a good way to put it. Then you have the more traditional supply and demand factors, things like mining output, central banks buying or selling reserves, jewelry demand. These tend to have a slower impact usually than big macro news. And finally, don't underestimate market sentiment. Big speculative flows from hedge funds, even the collective action of retail traders, can really inject volatility, especially short term.
Okay, so we've got a handle on the why. Now, the how and when. For someone actually trading this, when should they be watching? What tools do the pros use? Gold trades 245, but you said not all hours are the same, right? You can't just jump in any time.
That's a really critical point for practical trading. Liquidity and volatility swing wildly across different trading sessions. The Asian session or Tokyo kicks things off. Generally lower liquidity, smaller moves. It can be good for spotting early ranges or potential breakout setups, but it's often quieter.
Okay, then London wakes up.
Right. As the London session opens, liquidity ramps up significantly. London often drives trend continuation or sets a new direction for the day. Then, the New York session. That's typically peak volatility time. Strongest trends often happen here, and major U.S. economic news drops during this window.
So if you're looking for the main action, the most movement.
The sweet spot, the pros' focus time, is usually the London and New York overlap, roughly 13:00 to 17:00 GMT. Highest volume, highest liquidity, trades execute better, spreads are tighter, and you often get clearer directional moves. That's when the big players are really active.
Right, prime time. Okay, let's unpack this next bit. You know when to look.
Right.
What are you actually looking for on the charts? Pros aren't just staring at squiggly lines, right? They're decoding signals.
Exactly. And given gold's nature, volatile liquid technical analysis is huge. It's basically studying past price action to anticipate future moves. A big part is trend analysis, using tools like moving averages, specifically EMA's exponential moving averages. The 20, 50, and 200 period EMAs are very common for gold. Here's a real nugget for XAUSD. Watch those EMA crossovers. When the shorter term, say the 20 EMA, crosses above the longer term 50 EMA, that often signals a strong uptrend gaining steam. very useful in gold's trending phases.
Okay, EMAs. What else?
We use trend lines and channels to visually frame the price action, spot potential breakouts or reversals, and, of course, support and resistance levels. These are key historical price zones where buying or selling previously dominated. And pay attention to the big psychological levels, too, like $2,000, $2,100. Round numbers matter because lots of people watch them.
Right. Self-fulfilling prophecy sometimes.
Can be, yeah. Then you have indicators, things that give potential buy-or-sell signals. The RSI, Relative Strength Index, is vital. Shows overbought, usually above 70, or oversold, below 30 conditions. And a pro tip here, look for RSI divergence. If gold makes a new high price, but the RSI makes a lower high, that's a warning sign. Weakening momentum, potential reversal.
Interesting divergence. Okay, what else?
MCD, Moving Average Convergence Divergence, helps gauge trend strength and spot reversals. Bollinger Bands are great for volatility. They squeeze when volatility is low, often before a breakout, and expand when it's high. And don't forget candlestick patterns. Things like engulfing bars, hammers, shooting stars, dojis, pin bars. They give you immediate visual clues about sentiment right at that moment.
Okay, lots of technical tools there. But you said earlier it's not just about the lines on the chart. You need to know why they're moving. This is where fundamental analysis comes back in.
Right.
As a complement.
Absolutely essential. The best traders blend both. You need the why behind the what. So understanding those underlying economic drivers is key. Major data releases like the U.S. non-farm payrolls NFP report that's huge for the dollar and gold. CPI and PPI inflation data are critical. FOMC meetings, Federal Reserve decisions on interest rates, massive impact potential.
Right, the Fed days are always big market movers.
Huge. And then unpredictable geopolitical events. They can just blow everything else out of the water sometimes. Like we said, high CPI might normally weaken gold via a stronger dollar. But if major geopolitical tensions flare up simultaneously, gold could soar as a safe haven, completely overriding the CPI data. Understanding that constant interplay is vital.
Okay, makes total sense. So with all this knowledge, the why, the when, the what do expert traders actually do? What are the common strategies? And maybe most importantly, how do they handle the risk? Because gold can move fast.
Right. This is where theory meets the trading desk and discipline becomes everything. A core strategy is trend following. Pretty simple concept. Buy in uptrends, sell in downtrends. Often uses those EMA crossovers we talked about, like 20 crossing 50, as entry signals. Great for gold's strong trends, often used for swing trades lasting a few days.
Okay, following the current. What else?
Range trading. When gold isn't strongly trending, maybe between news events, it often bounces between clear support and resistance levels. So traders buy near support, sell near resistance, usually confirming with an indicator like RSI showing oversold or overbought. Then there's breakout trading. You wait for the price to decisively break through a key level. But crucial point, wait for a confirmation candle close above resistance or below support. Avoid getting caught in false breakouts.
Ah, the fake outs. Yeah, those hurt. What about the really fast stuff?
That's the thing. Super short-term trades, maybe lasting minutes, even seconds sometimes. Usually done during peak volatility, that London-New York overlap, needs intense focus and really, really tight stop losses. We're talking maybe 5, 10 pips, tiny moves.
Wow, high intensity.
Very. And finally, some use hedging. Using gold strategically alongside, say, USD currency pairs or even oil to manage overall portfolio risk, like an insurance policy.
Okay. Now let's talk about that essential piece you mentioned, risk management. You hear veterans say it all the time. Trading is 95% risk control. What are the absolute must-do rules here? What do you have to get right?
That saying is spot on. Couldn't be truer, especially with gold. Rule number 1, non-negotiable. Strict position sizing. Never ever risk more than 1% or maybe 2% of your total trading capital on a single trade. This protects you from being wiped out by one bad move, which gold can deliver quickly.
1 to 2%, got it.
Always, always use a stop loss. That's your escape patch, the price where you admit you're wrong and get out. Place it strategically beyond normal volatility noise so you don't get stopped out prematurely. For taking profits, use a take profit level and aim for a positive risk-reward ratio. At least 1.2 is a common target, meaning for every dollar you risk, you aim to make at least 2.
Makes sense mathematically.
Yeah. Also diversification. Don't just trade gold. Spread your capital. And maybe the biggest temptation to avoid, over-leverage. Leverage magnifies gains, yes, but it magnifies losses just as much, if not more, psychologically. Gold can whip around 100 pips or more in minutes. High leverage with that is asking for trouble. It really forces you to ask, are you protecting your capital first before even thinking about profits? For pros, that's the primary job.
Yeah, that mindset shift seems critical. Protect first, profit second. What about the tools? What tech helps traders apply these strategies and manage risk?
Oh, technology is key now. TradingView is incredibly popular for charting. Its indicators, alerts, very powerful. For actually placing trades, MetaTrader 4 or 5, MT4, MT5 are the industry standards for many retail traders. They support automation too. For real-time news that moves markets, pros often use Bloomberg or Reuters terminals, and economic calendars are indispensable. Sites like Forex Factory, investing.com, you need to know when that big data is hitting.
Okay, so we've got the charts, the data, the strategies, the tools. But what about the person clicking the mouse? How big a deal is psychology in this game? Gold seems like it could really mess with your head.
It's arguably the make or break factor, honestly. Gold trading psychology is huge. It boils down to controlling your emotions. Gold volatility is a perfect storm for triggering FOMO, that fear of missing out.
Oh yeah, seeing you run and feeling like you have to jump in.
Exactly. Leads to chasing price, bad entries. And the flip side is revenge trading. You take a loss, feel angry or frustrated, and immediately jump back in trying to make it back. Almost always leads to bigger losses.
Been there. Doesn't work.
Never does. The key is discipline. Unwavering commitment to sticking to your trading plan, your rules, no matter what. If we connect this to the bigger picture, that emotional control, that discipline, that's often what separates the consistently profitable from those who burn out. It's less about knowing everything and more about doing the right thing consistently.
Can you give us like a concrete example?
Mm-hmm.
Putting it all together, technicals, fundamentals, risk, psychology.
Sure, okay. Imagine gold's in a clear uptrend. The 20 EMA is nicely above the 50 EMA. Momentum looks good. Then let's say the US NFT jobs report comes out weaker than expected. That's generally bad for the USD, good for gold, a fundamental catalyst. Price might pull back slightly after the news spike, maybe down towards that rising 20 EMA, say around $2,010. Maybe the RSI indicator dips near 40, suggesting it's not extremely overbought anymore. A disciplined trader sees this confluence, uptrend, technical, weak USD news, fundamental, pull back to support, entry point. They might decide to buy at $2,010, set a stop loss strategically below a recent low and maybe below the 50 EMA, perhaps at $2,000. That's their risk defined, $10 per ounce. Then they set a take profit target, maybe up at $2,040, targeting a previous high or resistance area. That gives them a $30 potential reward for a $10 risk, a 1.3 risk-reward ratio. It's about aligning the signals, managing the risk, and executing the plan without letting fear or greed take over.
That really crystallizes it, seeing how all the pieces fit together in a real scenario.
Exactly. And for traders who want to go even deeper, there are more advanced concepts. Things like understanding contango and backwardation in the gold futures market tells you about market expectations for future prices versus the spot price.
Right. That sounds complex, but potentially insightful.
It can be. Also, correlation trading, analyzing how gold moves relative to, say, silver or the USD index or even oil, looking for seasonal trends. Gold sometimes sees predictable demand patterns around certain holidays or times of year like Diwali or Chinese New Year. And deep volume analysis, looking at the amount of trading activity to confirm trends or spot exhaustion.
So always more layers to explore. Given all this, what are the classic mistakes you see new traders making with gold? The traps to avoid?
Oh, there are a few common ones, unfortunately. Number one, trading without any macroeconomic awareness. Just looking at charts, ignoring the big picture news and data. Fatal, closely related. Ignoring that crucial USD correlation. Can't trade gold effectively without watching the dollar. Overtrading during low liquidity sessions, like deep into the Asian session. Spreads widen, moves can be erratic. Bad combination.
Get chopped up in quiet markets.
Exactly. Then, the big one, using excessive leverage, thinking you can get rich quick. It just magnifies mistakes catastrophically with gold. And fundamentally, just ignoring risk management principles altogether, treating it like the lottery. That's the fastest way to lose your capital.
Okay, so we've journeyed through gold's mystique, its drivers, tactics, risks. After all this, what's the bottom line? What does this all mean for you listening? Let's try and crystallize the key takeaways from this deep dive. 1. Gold, safe haven, non-yielding. Reacts strongly to the USD, interest rates, inflation, and geopolitical shocks. Remember those key drivers. 2. You got to combine technicals and fundamentals, looking at charts and understanding the news. Two sides of the same coin for high probability trades. 3. Risk management isn't optional, it's everything. Seriously, one bad oversized trade can undo months of good work. Protect that capital. 4. Have a clear strategy trend, range, breakout, scalp, and know when to apply it based on market conditions. Don't just trade randomly. 5. Psychology, discipline, controlling emotions. That's often the real separator between pros and amateurs. And maybe 6. Gold trading isn't gambling. It's about probability. managing risk rigorously, and constantly learning about the markets.
Well said. And to cultivate that pro-trader mindset, always ask yourself these questions before clicking that button. Does this trade respect the macro picture, the technical signals, my risk rules? Am I actually trading my plan, or am I just speculating or chasing? And the big one, am I controlling my emotions right now, or are they controlling me? Honest answers are crucial.
That's powerful stuff. The world of gold trading, it seems complex, sure, but it really does reveal how interconnected everything is in global finance. So maybe as you catch the news tomorrow, think about how a central bank decision somewhere or a political flare-up miles away might actually be sending ripples through the price of that ancient, gleaming metal. After this deep dive, what will you notice next?